Asset inflation, bond bubble, the risks of the Fed. Today's a macro episode because the Fed gave their statement. The Fed talked about the new framework, and we can't not talk about macro all the time. It is part of our business. The purpose of this podcast is to talk about hedge funds and the management of hedge funds. And therefore you have to sometimes also go back to the macro side, even if you're a focused disruption, technology, and new innovation fund like us. This is the Not Even Wrong podcast. It's March 17, 2021. This is Krim Delco. For the day, the fund is up 3%. The market's up 60 basis points. For the year, we are now up 1.3%. The market's up 5.5%. We're underperforming by roughly 4%, a little bit less than 4%. So the market's still open, so these numbers can change. I just want to focus today on the macro side because of the Fed. The Fed gave their regular statement about the FOMC meeting and all that. Here's the thing that is driving the markets, that is driving the discussion in the markets. We have an unprecedented amount of debt which is being issued by the US Treasury and, by the way, by Europe and Japan, but let's focus on the US now. We have an unprecedented amount of monetization of the debt by the Fed. So basically the Fed is issuing the debt and the Treasury is issuing the debt and the Fed is buying the debt. And therefore we have a massive asset inflation. Let me unpack that. What does asset inflation have to do with that? Well, here's the thing. You have an amount of money coming is an unprecedented amount of money coming to the economy, and the money is not being spent on, let's say, Netflix subscriptions or bread or milk or sugar. It is being spent by buying other assets. And let's say if I listen to NLW's Buy Bitcoin podcast, which I think is a very good macro podcast, you get to the conclusion from there. You could gather that what's happening is that we have money coming from the Treasury, and people are putting that money into value assets. So they want to preserve the value of the dollar that they get today because they believe that the dollar will depreciate in the future. So the actual dollar that you got today is being spent in some sort of savings account. Now, because people don't believe in actual cash and they're not getting much on the savings account in banks anyway, they're buying assets that are supposed to keep the value or even increase the value. Those assets are equities, those assets are Bitcoin, those assets are Ethereum, those assets are gold, those assets are oil, things like that, copper. Some are better than worse. For example, gold has not been doing that well. Equities have done okay. What's done extremely well are growth equities such as Tesla and the CRISPR stocks. In our portfolio, we were up 5x last year partly because of that drive to these very high yielding assets. Because if you have very, very low interest rates, then the future cash flows are even more important than they are in normal times. So recently we had a little bit of a reversal. So the growth assets have lost relative to the value assets where the cash flows are more in the near future. But overall, people are still happy buying real estate, buying things that you think will be there will keep their value in the future. So this is the dynamic that is going on in the markets. Or you're buying anything you can get, NFTs, soccer teams, memorabilia. I thought whatever you think will have value. Now, value is defined as something that other people will pay for in the future. And if you have something like Bitcoin, that is also one of the big conversations on NLW's podcast is, well, we passed that threshold. We've solved that chicken and egg problem. People are buying Bitcoin because they believe that other people will buy Bitcoin, and therefore you have this virtuous circle, this flywheel, which is driving up the value. This is, in a nutshell, the way we see the situation. Now, the Fed, on top of everything, is committed to an inflationary monetary policy because they believe that they have to make up for lost inflation in the past. The argue there is, let's say, if I look at Macro Musings by David Beckenworth's podcast, that one is very interesting because it talks more about the actual mechanics of the current Fed and the current monetary policy. So it's an insider's view of what's actually going on with the U.S. monetary policy. And there, what we see there is in particular the need to keep nominal growth of the GDP going. And the reason Beckenworth's argument is, and this is kind of what the Fed is doing, although they're not calling it that way, this so-called nominal GDP growth, which is that in the end, everything in the world is nominal. So it's kind of like we have a real world and we have a nominal world, and the real world is what real value is. Real value is inflation adjusted. What can you actually buy for the money that you have? And then the nominal world is what you actually get, which is different. And the nominal GDP growth is more important because that's psychologically what people really care about. It's completely orthogonal to let's say the Chicago School of Economics, which just thinks in real terms and doesn't really care about nominal stuff, and therefore all this money printing is useless, etc. Now, I don't want to go down that discussion. All I want to say is that I think that the Fed is committed to this, and that's important, so they will do it. And another podcast I listen to, which is Hugh Henry's podcast, he keeps saying, well, the reason we don't have inflation is because people don't believe it. They think the Fed is not serious about this. They think the Fed is not actually going to do what they say they're going to do, which is really create inflation. And he's saying they should put me as Fed chair because I am crazy enough to actually do it. So anyway, this is Hugh Henry being Hugh Henry. But the point here is that you need, in the world of the Fed, you always need commitment. Commitment. Everything is about commitment. Why? Because you cannot have a situation, or here's the way I would want to phrase this. The Fed is fundamentally an institution which manages expectations in the markets, and or at least that's how they put themselves in. They weren't necessarily supposed to do that when they were founded, but that's where they are right now. And the point is that if you want to manage expectations, and you want people to believe in inflation, well, then you have to commit to it. You have to pretend that this is really what you want. And if everybody believes that that's what you're going to do, then that's what's going to happen. And what Hugh Henry is saying is that the Fed is not committed enough, that actually there isn't enough evidence that they will go for inflation, and therefore we have this situation where we have this money printing and no inflation. Now, I don't know if I believe in this, but this is the lay of the land. And now, what does this mean for us? What does this actually mean for us? Couple of things. First of all, we have asset inflation. So the stocks that we own went up because there is asset inflation. So if we were up 5x last year, maybe half of that is asset inflation, the other half is actual fundamental performance, actual what we call multiple expansion of the stocks, because they've actually delivered, or there is reason to believe that they will deliver, such in the CRISPR side. For example, Twist Bio has been very successful with the COVID-19 situation, and therefore there is reason to believe that this will continue. The other half of that performance could be attributed to things like this whole asset inflation. So this is the number one thing, the lay of the land. Number two, we have inflation also in the supply chain, something that companies like Tesla are managing very carefully. They're absolutely committed to, of course, make sure that this doesn't become a problem. But it is an issue. We had some issues with supply chains in the first quarter. I believe, like most observers, that this is a temporary thing because we had the COVID shutdowns, and that the supply chains will readjust. On top of that, the Tesla supply chain is a new supply chain anyway, because we are trying to build 20 million cars in 10 years. There will be enormous amounts of value creation on the Tesla front, and whatever they offset on the other. So if we have the OEMs struggling and reducing their investments and things like that, that will be offset by the EV investment. We believe we will have many millions of cars per year produced on the EV side. So there's a lot of potential for economic growth on that front, and therefore we shouldn't be concerned about this disruption from that perspective. So here, the summary in terms of what is the current macro conversation, and then I want to give our views on how we position ourselves. The current macro situation is the following. We have enormous amounts of government debt. It is being monetized by the Fed. That means the devaluation of the dollar relative to other assets. That means asset inflation. We believe that we have either this is right and we're okay, or this is wrong and we're okay. So we believe that we can do well in both scenarios, if this is right or wrong. If this is right, then, well, we are invested in high growth assets. They will, by definition, do well in an asset inflation environment, which has happened in the last year and will continue to happen. So if we're right, if this is exactly what's going on, then we're fine. But here's the thing: we actually are making a contrarian call at Orange Capital Partners that we don't believe that asset inflation and devaluation of the dollar are the biggest issue in the macro side. Actually, we believe that it's the other way around. That we have an enormous amount of value creation and that there's not enough money being printed to grow with the amount of growth that we're going to see in the next 2 decades. There are four big drivers of technological innovation which will redefine the global economy for the 21st century. Number one, electric intelligent cars with AI, so the AI side, self-driving cars. So that means transport is decarbonized and is algorithmatized. So basically, we don't have to drive cars and trucks anymore. Number two, CRISPR and the digitization of life sciences. We have a deterministic way to solve healthcare problems versus this bespoke, random way that we have been using for the last hundreds of years. Third, blockchain, which is identity and trust in a decentralized network, solves problems like the law, finance, like things like that, that have enormous amount of transaction costs today, will be made much easier. And also, not just when we look at these types of things, never forget it's not just that we're replacing the old system, we're going to create many, many layers of new businesses and values on top of that. So, for example, we will have jobs like the an NFT hedge fund or something like that. These jobs don't even exist today. So these NFT hedge funds will create enormous amounts of value for people that like to invest in NFTs. There will be knowledge creation in that on that front that we don't even know what the knowledge will be like today. So anyway, fourth, quantum computing. Quantum computing will just change the class, all the mathematical and computational problems that we see today on the classical side will be transferred into the quantum side. Again, you will have, first of all, the first order change, which is, okay, what can we do now? What can we do tomorrow? Some things cannot be done, like RSA security cannot be done. We have to invent new ones. One-way functions, for example. So the hash functions in cryptography will not be one-way functions anymore because quantum computing can make it two-way. But what that means is that you have an f of x, you know the x, and you can calculate f of x, but you can, once given f of x, you cannot get back to x. Okay, so I know that if f of x is if x is 2 and f of x is 6, then f of x is 3 times x, for example. I can figure that out, but if it gets more complex, I can't figure it out anymore. Quantum computers could figure that kind of two-way out. Well, we will just have to create new one-way functions. So those are the four big trends. Two of them were invested in, two of them were not invested in. For us, again, this is a very good scenario because if we're right and the value creation is so massive that the money printing can't even catch up with that, so we'll have deflation here. We'll have deflation. So the dollar will buy you even more today than in the future because there will be a lot more products and services available at much, much better prices. If we're right on that, then again, we are the wealth creators because we're invested in those wealth creation businesses like Tesla, again, fundamentally Tesla and CRISPR. We will also start investing in the blockchain technology, smart contracts, Ethereum, and things like that. Algorand, definitely it's coming. We're working on it. And then the last one, the quantum computing side, might have to wait a little bit. So the conclusion on our side is the current Fed conversation is about devaluing of the dollar and monetization of the debt. It is a problem. It is not good. But we think that actually the innovative strength of the economy is going to dwarf those political and socio-economic issues, and that we're looking into a very bright, positive future with lots of value creation and lots of wealth generation. Thank you.